Hello and thank you for watching. This is Rene Ruiz. I'm with Nationwide Purchase Loans and I am very grateful that you're here today. Today I'm going to be presenting on cost segregation studies and their tax benefits. Now, of course, this is relevant because everybody loves to save money on taxes, but we've been meeting a lot of first-time investors lately and I thought it would be appropriate to put this video together because a cost segregation study is a highly effective tool that can be used to accelerate depreciation write-offs. At the end of the day, it means more money in your pocket because the goal is to increase cash flow. Now, before we go into what a cost segregation study is, first, let's go back to depreciation. This is the reduction of the value of an asset over time. For accounting purposes, it's the method used to allocate the cost of a tangible or physical asset over its useful life. For tax purposes, it's a write-off against the income produced by that property or investment. Or if you're a real estate professional, it's just a write-off. Normally, we calculate depreciation using a straight line method. You start by dividing the difference between an asset's cost or price and its expected salvage value by the number of years it's expected to be in use. By nature, you use estimates and you assume that the wear and tear is perfectly gradual, which it is not. And it disregards the effects of inflation due to the increases in maintenance over time. So this is why a cost segregation study is better. First, you have someone do an inspection and they come back with a report that categorizes the various parts of the property. The electrical, the plumbing, the roof, the windows, fixtures, as well as estimating their cost to replace. Some categories can be depreciated in 5, 7, or 15 years. And fact is, standard depreciation schedules call for 27.5 on residential properties and 39 years on commercial. So if you can take that depreciation write-off that you were going to get anyways, and you can reduce it so that it's being written off in a shorter period of time, in 5 or 7 years, you're going to get a way bigger write-off. That's how you increase your cash flow. At the end of the day, it means you're going to be paying less taxes on those rents. Now, here's an example that I pulled from the Poplar website. And I like this example because it uses some pretty simple numbers. It's $1 million property. First, you take into account that you can't depreciate land, so you only really look at 80% of that million. And when you take $800,000 and divide by the 27.5 years that the IRS allows as a standard depreciation schedule, you end up with a write-off of $29,000 per year for 27.5 years. But if you were to get a cost segregation study done on the property, they could potentially come back and say that 30% of the property could be depreciated over 5 years. That increases the write-off to $60,000 for the first 5 years. Now, the amount of the write-off isn't really necessarily going to be changing. It's the acceleration. It allows you to keep more of your money so that you can build that real estate portfolio faster, because that's what it's all about. A few things to remember. These are tax deferral strategies and the depreciation gets added back when you sell unless you use a different tax strategy to defer. Again, only real estate professionals can deduct depreciation from their standard income. And if you have more questions, we have CPAs ready to work with you and answer your questions. Thank you for watching. Thank you for your time. And if you can think of any other topics that you'd like me to cover, please shoot me an email or give me a call. I'll be happy to put the video together for you. Make it a great day.